Good evening. It is Thursday, February 22nd, 8:30 p.m. People, I want to thank you so much for your comments. I want to thank you so much for your viewership. It really means a lot to me. Sincerely, I really want to thank you for all that. And I was really looking forward to getting this video out today. We have another usual suspect to add to our list. Randy Quarles. He's one of the newest Fed governors that President Trump appointed. All right, and just like all the others, he goes around the globe on our dime, talking out of both sides of his mouth. So he shows up in, of all places, Tokyo today to give a speech. All right, why on earth does a Fed governor have to go all the way to Tokyo to give a speech? Fed Governor Randall Quarles said in a speech Thursday that inflation running a little below target shouldn't stand in the way of future rate increases. So he's one of these guys, gradual pace, but we have to watch the data. With the central bank expected to hike at least 3 times this year, the newest Fed member said he supports a continual, gradual pace of increases. Very ambiguous. If you had this word count, okay, it's basically the same words that crop up over and over again. You got gradual, you got pace, you got inflation, you got 3 hikes, you got 4 hikes, you got growth, you got 2%, okay, you got transitory. It's all the same words over and over and over. They just regurgitate. The Fed shoots for a 2% inflation rate that it believes represents an equilibrium growth level. Can't be 1.5, can't be 2.5, can't be 2.1, can't be 1.9. It's got to be 2. Okay? That's what they're shooting for. That's not their upper limit, though. Okay? It's not like Europe, okay, where it's 2%, that's the max. No, here it's okay, we'll see, we get to 2, okay, as if they can stop on a dime. After assessing the recent data, now that recent data is the personal consumption, okay, expenditures, which came in lower than their target, okay, their ill-conceived target. It came in at 1.7%. So if it came in lower than their target, why are they raising interest rates? Okay, they have this dual mandate: maximum employment, price stability, right? They can't hit their target, and yet they're raising interest rates. Because they're boxed in, because they brought them to zero, because they know a recession is coming, okay, and they have to have a cushion. After assessing the recent data, my take is that the current shortfall in inflation from target as most likely due to transitory factors. There it is again, transitory. How long is it transitory? How long is transitory? How long has it been since they can't hit 2%? How many years? This is transitory? This is nonsense. He thinks it's transitory factors that will fade. There's that fade word again. Like Scott Nations, that jerk from 2 Fridays ago. He said he was going to fade gold because it wasn't doing what it was supposed to be doing, right? It should have been dramatically higher. Well, Scott, why don't you just look at a chart before you open up your mouth, okay? You look like a jerk then, you're a bigger jerk today, okay? I'm saying it as it is, all right? There's a lot of people, they got the gift of gab. That's all they got is the gift of gab. You can see I'm in a little bit of a seedy mood here tonight. Factors that will fade through 2018, pushing inflation back up to the target, Quarles said at the 26th International Financial Symposium, sponsored by the Institute for International Monetary Affairs. Suffice to say, a deviation from our target of a few tenths of 1%, they're going to try to calibrate this, a few tenths of 1%, especially when I expect to fade. What is this guy, a crap shooter? He's fading, right? Does not cause me great concern, he added. The event was held in Tokyo, and Quarles spoke in the afternoon Thursday local time. Isn't that nice? His comments came at a time when the market expects the next rate hike increase to come at the March meeting of the FOMC, right? Federal Open Market Committee. Okay? Markets have been on edge lately on whether the Fed might decide that the economy is running too hot and in need of more aggressive monetary policy tightening. Traders in the Fed funds futures market current have 3 rate increases pretty well priced in, and they are priced in, okay? Though there's a 30% chance of a 4th rate hike according to the CME's Fed Watch tracking tool. Qualls did emphasize that the Fed should be patient and condition future increases on continued progress in inflation and unemployment. So there you go again. It's all about the data. Maybe we will, maybe we won't. We can, but we have to see. I mean, do they think we're stupid? How have they managed to get along with it this far? Dan Bullard, another usual suspect, right? Retired now, but he shows up every chance he can on CNBC, okay? And he says things have to be pretty much perfect for the Fed to be raising rates. So he goes out there to calm the markets, all right? Now, you got Art Cashin. He said all hell will break loose if the 10-year goes to 3%. And it is going to 3%. All right? It could be a bad day for the markets once the yield on the benchmark 10-year Treasury hits 3%. Closely followed trader Art Cashin told CNBC on Thursday. That 3% level is both a target and a kind of resistance. Everybody knows it's like touching the third rail, said Cashin, UBS director of floor operations at the New York Stock Exchange. The assumption is once they do it, all hell will break loose. So we'll wait and see. There are a lot of trends in place right now, people. The yields are going up. That's a trend, okay? It's not going to go up every day. They're going to fight this. They're going to fight tooth and nail this 3%. You can bet on that, okay? But that trend is clearly in place. Gold is going up. Gold is up $300, basically, from the 1050 lows back in December of 2015. Yet you wouldn't know it by the sentiment. And that's a good thing, because I think, and I said it yesterday, gold is climbing a wall of worry, okay? It rebounded today a little, all right? It's, as far as I'm concerned, clearly showing strong support above this 1300 level. So I'm okay with it. I really am. As of early Thursday, the 10-year was slightly lower, around 2.91. The 10-year is back up to 2.94, okay? So, again, they're trying to hit it down, and it's coming back. The 10-year is 2.94. The 30-year is back up to 3.21. These rates are rising, okay? Initially, yields moved down. Stocks rallied like crazy. And these stocks, right, I said the top is in. I believe that to be true. The Dow was up 164 points today, but at one point it was up over 300. Yesterday it sold off. It was a 500-point move, right, from the top to the bottom. Today it was up over 300 points. It gave a lot of that back, okay? The S&P and the NASDAQ and the Russell were all basically flat, all right? The dollar, 89.80. The rally seems to be fading, okay? That, if I'll use that word. The dollar rally seems to be fading. The yen was stronger today, okay? The VIX, once again, the VIX was down 6.5% today. There's still no fear in these markets, all right? Initially, yields moved down. Stock rallied like crazy, Cashin recalled, about Wednesday. That was yesterday. Moments after the Fed minutes were released. Then about 8 minutes into that move, stocks looked back and noticed bonds had changed their mind. These bond yields are changing their mind. You read an article in the morning how the yields have come down. By the end of the day, the yields are right back there. The term bond vigilantes was coined by market historian Ed Yardeni during the 1980s, referring to traders who sell their holdings in an effort to enforce what they consider fiscal discipline. Fiscal discipline, if there's one thing that this Fed does not have, it's fiscal discipline. Selling bonds sends yields higher due to the inverse relationship between bond prices and bond yields. We're going to need a couple of weeks to see if the bond vigilantes really are back or not, Cashin said, or whether it was simply a fluke. But remembering what bond vigilantes look like, it certainly had fingerprints on them. Bond vigilantes are back, yields are going higher, we're going to take out 3%, and all hell is going to break loose. And I think you're seeing that in gold. Try as they will to keep it under 1340, and they've managed to do that. They're going to fail. You could see that the takedowns are less effective, they're shorter, they're shallower, okay? And it comes back. Now, this morning, I snapped this picture. It was 8:22 New York time, gold. They tried to take it down, and it comes right to me. That's a strong sign, if you ask me. Okay? They try to take it down, does a double bottom right at that 1321 level, and then it goes up again. Then I snapped another picture. This was 12:29 New York time. Gold, looking very strong. So I'm quite happy with gold. The bonds, right here, early in the day, that's that 2.91, right? But nevertheless, it came right back to 2.94. Now, Goldman, I said this yesterday, Goldman Sachs sees a greater than 95% chance of a Fed rate hike in March. So these Fed rate hikes are priced in, okay? And what did I say in December, right? How, for at least 6 weeks out, maybe even more, right? Talking about this December rate hike. I kept saying, bring it on, bring it on. I was salivating, bring it on. Well, what am I saying about this 95% chance of this March rate hike? I say bring it on. Let's bring it on. I can't wait because I know what's going to happen, okay? Gold's going to go up the next leg higher, okay? So let's bring it on. Shortly after the meeting minutes, yesterday's Fed minutes, were published Wednesday, Goldman Sachs upwardly revised its probability of a March rate hike to more than 95%. Okay? Robust economic data, accommodative financial conditions, and the impact of the recent tax overhaul all contributed to the U.S. Central Bank improving its economic outlook. That's a bunch of nonsense, but regardless, okay? So, we have Goldman, 95%. So, that's about it, people. We have to just keep our eyes on the ball. It's all about the rates, okay? I believe stocks have topped, okay? We're going to have some up days. We're going to have some down days. But I believe the top is in for stocks. I like gold. I really do. Okay? It's behaving quite well. Okay? I think these are strong trends in place. I think the dollar is ready to resume its downward trajectory, and I think it's only a matter of time that gold breaks through this very, very difficult resistance, which it is, and goes up to the next level. So I've said before, patience and hope is not an investment strategy. It's not. So all these people, gold, in the 5 years ago, go in the long term, you gotta be paid. No. Not that kind of patience. I'm not talking. But right now, we gotta be a little patient with this gold. It's okay. It's doing okay. So I'm happy to see that. Anyway, again, I want to thank everyone for their viewership, and Lord willing, we pick this up tomorrow. Have a good night, people. Ciao.